So there's an ETF that everybody's been talking about lately because of a dividend yield that is almost unbelievable, 12%. I'm talking about JEPI, JP Morgan Equity Premium Income ETF. And lately I've heard many unrealistic views about this ETF on YouTube, so I decided instead to analyze it and give you all the necessary information that you need to understand if it's worth investing in this ETF or not. We're gonna talk about the covered call strategy of JEPI and how it's gonna play out in the future, as well as what you can expect based on the underlying stocks. I'm also gonna show you how, although JEPI has been present since 2020, you can actually see the historical results of this ETF even from the previous years. Now, the big winning point of this ETF is of course the dividend yield, but the big question remains open. What am I gonna expect from JEPI in the next years? Before we dive into this, let's see if JEPI meets all the basic requirements for a good ETF. I do have a video where I go in depth over all the criteria that you need to consider when you're looking for an ETF. And I also help you set up a free ETF screener, so you can check this video later. But now, a quick recap. You need to look for a high number of assets under management, a high diversification, a relatively low volatility, a low expense ratio, and a long track record. JEPI is an actively managed fund that invests in a variety of stocks with an emphasis on high-quality companies that have a history of stable earnings and attractive valuations. It provides a good level of diversification thanks to the 136 companies it includes and because of the optimal distribution across the sectors. The expense ratio of 0.35% could be better, but considering that the fund is actively managed, it's actually low, and you can live with it because it means that you pay $35 every year for every $10,000 of this ETF that you possess. $21.8 billion of assets under management also assure you stability and credibility. But of course, the greatest point of this ETF is a dividend yield of 12%. So in order to analyze this ETF, the first point to understand is how it makes money. JEPI seeks an annualized target yield of at least 6 to 10%. And it does this in three ways: equity income, capital appreciation, and covered call options. The equity income strategy is when you have companies that pay you dividends, giving you lower volatility. The capital appreciation strategy is when you buy stocks of companies with attractive valuations seeking an increase in market value. But the interesting thing is the covered call option strategy. So here's how it works. Let's say that there is a seller that owns a particular stock, and on the other side we have a buyer that is interested in the stock. The stock is valued $100, so the buyer could buy it for $100, but instead they decide to make a contract for a price of $110. This contract is called call option, and the price of $110 is called call price. Now this contract says, buyer, you can buy this stock in the future for $110, even if the real price has reached a higher value, like $200. But in the meantime, you regularly pay the seller a so-called premium, which is like a fee. So if the price of the stock grows over $110, the buyer has the advantage to buy cheaper at $110. But he also has the disadvantage that in the meantime, he needs to pay this premium. So to execute a covered call strategy, the portfolio manager of JEPI acts as a seller and sells a call on the underlying assets of JEPI, collecting the premium from the buyers, but he also holds an investment in the same underlying assets. So the manager of JEPI earns when JEPI grows in value, but also because of the premiums they're receiving. So when would JP Morgan have the worst payoff and when the best? The maximum loss would be if JEPI goes to zero, obviously, but they would still collect the premiums from the investors because the price never reaches the call price they agreed on. And this is partially how JEPI reduces overall volatility. On the other hand, they would have the best payoff if the stock price increases, but just below the call price. In this way, they could keep the underlying stocks because they don't have to sell them, but they will also keep collecting the full premium. Together, the strategy of owning the underlying stocks of JEPI and selling the call options produces a dampened downside and a capped upside. In a declining market like the one that we've had in the last 18 months, a covered call approach will produce better results and less volatility. However, in a bull market, it will not capture the full upside because at some point the call price is reached and any additional growth will only cause the buyers to buy at the call price. Now you're starting to understand that the amount of premium that JEPI will receive in the future is an important factor for the gains of this ETF. The value of this premium is based on several factors, but volatility and interest rates are the primary factors because they are subject to change in different time periods. As I said, JEPI is seeking at least 6 to 10% growth per year, and they do it through 1 to 2% pure dividends, an option premium of 6 to 8%, and the rest in capital appreciation, which is variable. Because of this high dependence on the premium, the fund is expected to perform well in an environment with higher volatility, and in particular in a declining market like the one we've had in the last 18 months. But it's expected to underperform when the market recovers. Okay, now we know how covered calls work. Now we ask ourselves, do covered call strategies usually outperform the stock market or not? Well, in most cases, they don't really. If you take, for example, the Global X S&P 500 Cover Call ETF, ticker XYLD, created in 2013, you can see that the long-term returns haven't outperformed the S&P 500. Now, let's talk about historical results. JEPI was started in May 2020, right after the COVID crisis. So of course it grew from the beginning and everybody on YouTube can say how great it performed. But knowing the long-term past results of an ETF is incredibly important to be able to evaluate it. And if you've seen other YouTube videos on the topic, you've probably heard that there is none, because JEPI started in 2020. Well, it's not true. In order to see at least 5 years results, we just need to check the mutual fund equivalent, which is the JP Morgan Equity Premium Income Fund, JEPIX. JEPIX has been around longer and gives us slightly more clarity on return expectations. Both funds, JEPI and JEPIX, are run by the same portfolio managers and have almost identical holdings, although JEPIX has a higher expense ratio. Now, as you can see, over a nearly 5-year period, the fund has slightly underperformed the S&P 500. This could be partly because of the exposure to the defensive stocks, partly because of the cover call strategy, and partly because it's an active managed fund. And usually actively managed funds underperform passively managed ones. But let's take a closer look at JEPI now. Compared to the benchmark S&P 500, JEPI has a big underweight to the information technology sector and an overweight to utilities and consumer staples. And this gives us an indication that the portfolio is clearly a defensive portfolio. This has caused JEPI to lose less than the S&P 500 in the last year, but it may be an indication that in the long term it will underperform. To see how this plays so far, we can take the sector-specific ETFs and compare the results of the last 2 years. In this graph, you can see the development of 5 different ETFs. We've got GPSC, the S&P 500 index, VDC, the Vanguard Consumer Staples ETF, VGT, the Vanguard Information Technology ETF, VPU, the Vanguard Utilities ETF, and VIS, the Vanguard Industrials ETF. So you can see here that in the last 2 years, the defensive strategy has brought positive results. All 3 overweight sectors of JEPI, which are consumer staples, utilities, and industrial, outperformed the S&P 500, while information technology underperformed. This explains why JEPI has been producing these results in a short period of time with less volatility. But if we extend the sector analysis to the last 5 years, we see a different picture. All the big sectors of JEPI underperformed the S&P 500, while information technology significantly outperformed. If the information technology sector were to suddenly outperform significantly, JEPI would show underperformance for 2 reasons. 1, because of the underweight of information technology in the sector composition, and 2, because the short calls would be triggered. So I don't want to say with this that JEPI is a bad investment or that it will surely underperform in the future. In fact, it might also be that the defensive sectors will outperform in the next decade. But I believe you should know that the growth of the last 2 years, and therefore also the generous dividends that these companies were able to distribute, has mostly been because of a perfect start date together with a defensive strategy. And this outperformance may not last in the future. So is there an upside potential? Of course there is. We don't know how the market is going to develop, and a flat or declining market with higher interest rates may create better option premiums and make JEPI outperform in the short term. And let's not forget that the fund is actively managed, so they may be able to make the right choices to protect themselves from underperformance. But will the fund be able to keep such a high dividend yield? I don't think so. So who should own it and who shouldn't? In general, I would say that if you're investing for the long term, JEPI might not be your best option because higher fees and an active management style won't likely lead to outperformance in the long term. And if you stumbled upon JEPI because you like dividends and you want a constant monthly distribution of dividends, also in this case, JEPI will not be your best choice because I expect higher volatility in the monthly distribution of dividends in the future. There is nothing intrinsically wrong with JEPI, and actually, I do believe that he has a great potential for the future. But I think that every investor should be aware of what I said in this video, not just hear people that say that you get 12% dividends per year or that JEPI outperforms the S&P 500, because it's simply not true. Next week, I'm going to publish a video about the best dividend ETF portfolio composition. So if you like ETFs, don't forget to subscribe to my channel and drop a beautiful like to this video. Thank you so much guys for watching till now. I wish you a great evening, and as always, I'll see you in the next video. Ciao!